The world of finance rarely sleeps, and its pulse can be felt at all hours, from the glow of city lights to the hum of trading floors that never truly go dark. A recent announcement from Milan has proven just that, reminding us that major financial decisions can unfold at any moment, catching even seasoned investors off guard. On Sunday, December 1st, 2025, Borsa Italiana SpA, the operator of Italy's stock exchange, delivered news that sent ripples through the market and quickly became the talk of the financial world. A special panel convened and made a significant decision. They increased the price for a mandatory takeover bid on Palingeo, a company listed on its growth market, signaling a rare but impactful intervention. This is not a common occurrence. It means the initial offer was deemed too low by regulators, who are tasked with ensuring that all parties are treated fairly, and that no shareholder is left at a disadvantage. The panel's intervention is designed to protect all shareholders, especially smaller investors who might otherwise be overlooked in high-stakes deals like this. By mandating a higher price, the panel enforces fairness and transparency in the takeover process, setting a precedent for how similar cases might be handled in the future. The new price becomes the legal benchmark for the transaction, serving as a reference point for all negotiations and future bids. This move forces everyone involved to reevaluate the company's worth and the deal's economics, prompting fresh analysis and debate among investors, analysts, and executives alike. The decision raises important questions. Why was the original price too low? Was there information that bidders missed, or was the market undervaluing Palingeo's potential? What factors led to the new figure? Was it based on recent performance, future projections, or perhaps a reassessment of the company's assets and growth prospects? The market must now digest this information and anticipate the consequences, as investors and analysts scramble to adjust their strategies in light of the panel's decision. Thanks to the panel's decisive action, Palingeo's takeover story has entered a new, more interesting chapter, one that will be closely watched by the entire financial community in the days to come.
A takeover bid is when one company or group offers to buy shares of another, aiming to gain control over its operations and strategic direction. This is a common event in the world of business, especially among publicly traded companies, and it can have significant consequences for everyone involved, from employees to investors. The acquiring party might see untapped potential in the target company, believe the shares are undervalued, or want to merge operations to create a stronger, more competitive business. Sometimes it's about expanding into new markets or gaining access to valuable technology or expertise. Takeover bids can be friendly, with both companies' managements agreeing to the terms, or hostile, where the acquiring party bypasses the board and goes directly to shareholders, often leading to tense negotiations and uncertainty. In Palingeo's case, it's a mandatory takeover bid. This is triggered when someone acquires a set percentage of voting shares, usually 30% in Italy. At this threshold, the law requires the acquirer to make an offer to buy out the remaining shareholders. The rule exists to protect minority shareholders, ensuring they can exit at a fair price if control changes hands. It prevents larger investors from taking over a company without giving everyone else a chance to sell their shares under the same conditions. Without this safeguard, new owners could make decisions that disadvantage smaller investors, such as changing company strategy or management in ways that hurt share value or reduce influence. The mandatory bid gives all shareholders a chance to sell at the same regulated price, which is often set by strict legal guidelines to ensure fairness and transparency. Regulators like Borsa Italiana act as referees, overseeing the process to make sure it's fair and that the price offered truly reflects the value of the company. They review all documents and can intervene if something seems off. This framework creates an orderly market and gives investors confidence that their interests are being protected, even during major changes in company ownership. The goal is to balance the interests of acquirers who want to grow or restructure, and existing shareholders who deserve fair treatment and transparency throughout the process. Ultimately, the process is designed to ensure fairness and stability during transformative company events, protecting all parties and maintaining trust in the financial markets.
At the heart of the panel's decision lies a straightforward but powerful move: The takeover bid price for Palingeo was officially raised from €6 per share to €6.61 per share, a change that immediately caught the attention of investors and analysts alike. This represents a 10.2% increase, a significant jump in financial terms, especially in the context of a high-stakes corporate takeover. Panels overseeing such deals operate under strict regulatory guidelines, weighing factors like the highest price paid for shares in recent months, average trading prices, and the overall fairness to all shareholders. After a thorough review, the panel concluded that the original offer significantly undervalued the company, failing to reflect its true market worth and future potential. For shareholders, this decision translates directly into higher returns. 1,000 shares now yield €610 more than before, a windfall that can make a real difference for individual and institutional investors alike. On the other side, for the acquiring company, this adjustment means the total extra cost could easily run into millions of euros, fundamentally changing the financial calculations behind the deal. This isn't just a minor tweak, it's a direct and substantial transfer of value to existing shareholders, rewarding them for their stake and patience. The panel's intervention signals a clear and substantial disagreement with the bidder's initial valuation, sending a message that lowball offers won't go unchallenged. With this new price now set as the legal minimum, the economics of the entire deal are fundamentally altered, raising the stakes for both sides. It's a textbook example of regulatory power in action, demonstrating how oversight bodies can shape the outcome of major corporate events. The panel's intervention also ensures that minority shareholders, often the most vulnerable in these situations, are protected and receive fair value for their shares. Now, the market must recalibrate around this new, higher benchmark as traders and investors adjust their expectations and strategies in real time. The story of Palingeo's takeover has taken a dramatic turn, and with this bold move, the next chapter promises to be even more compelling.
The price change wasn't made by Borsa Italiana's management, but by an independent panel of experts. Their job act as impartial referees, ensuring market rules are applied fairly. When disputes arise, like over the correct bid price, the panel reviews evidence and makes a binding decision. In Palingeo's case, the original €6 offer was challenged, prompting a detailed review of past share purchases. The panel's forensic analysis led to the new price of €6.61. This mechanism protects market integrity and prevents acquirers from underpaying. Minority shareholders can trust their rights are protected by an independent authority. The panel's role is essential for trust, especially in growth markets with higher risks. Their decision in the Palingeo case is a textbook example of market safeguards in action. Fair play isn't just a principle, it's enforced.
To understand Palingeo's takeover, you need to know about Euronext Growth Milan. It's a market for small and medium-sized companies with big ambitions, offering access to capital and visibility. Listing here is faster and less costly than on the main market, making it ideal for dynamic businesses. Palingeo fits this profile, a growth-focused company seeking capital and recognition. For investors, it's a chance to get in early. Higher risk, but potentially higher reward. Regulations are more flexible, but investor protections remain strong. The Palingeo case shows that even in growth markets, robust safeguards are in place. Euronext Growth Milan balances opportunity with fairness and transparency.
The panel's decision to raise the bid to €6.61 is great news for minority shareholders. They now get a 10% higher price, an immediate benefit. For those who thought €6 was too low, this validates their view. The new price, vetted by an independent panel, gives shareholders confidence to sell. Those who already plan to sell get a bonus. Those undecided may now be convinced. The higher price sets a new floor for the stock's value. Some long-term investors may still hold out, believing in greater future value. The decision doesn't force anyone to sell. It just ensures fairness for those who do. Shareholders now have a clear, regulator-approved choice. The panel's intervention removes uncertainty and rewards patience.
Raising the bid price changes everything for the acquirer. Their costs jump by over 10%, forcing a reassessment of the deal's value. The acquirer must now find extra capital and reconsider their investment strategy. Higher costs mean lower expected returns and could impact future plans for Palingeo. The new price becomes the market's reference point, with arbitrageurs keeping the stock price close to the offer. For Palingeo, the higher valuation is both a compliment and a challenge. This sets a precedent. Future bidders will know regulators enforce fair pricing. The decision strengthens a culture of fairness and transparency. The rules are real, with real financial consequences. The Palingeo case will shape future takeovers on the market.
For Palingeo, the takeover process is disruptive but also validating. The higher bid price, approved by regulators, affirms the company's value. Management must balance day-to-day operations with the demands of the bid. Employees may feel reassured by the premium price, but uncertainty remains. The process diverts attention and creates strategic uncertainty. The sooner the deal closes, the sooner stability returns. After the takeover, the new owner will expect strong performance to justify the higher price. The company's leadership must adapt quickly to new expectations and realities.
With the bid price set at €6.61, the next step is the formal launch of the offer. The acquirer will publish an official document detailing terms and the acceptance period. Shareholders will decide whether to tender their shares. Most are expected to accept the attractive, regulator-approved price. If the acquirer secures a high percentage, they may delist Palingeo and take it private. For Palingeo, this could mean the end of its public company journey and new strategic freedom for the owner. Minority shareholders who stay risk-holding illiquid shares in a private company. The panel's decision has set a clear sequence in motion. Offer, decision, and likely a new chapter for Palingeo. The market has witnessed regulation working as intended, ensuring fairness at a critical moment.